Hi, folks. Ryan Honeyman here from Lift Economy. Many folks have come to us over the last 10 years and asked, how do I get more involved in creating an economy that works for the benefit of all life? They also ask, what skills and experiences do I need to help make this transition? So, 3 years ago, we created something called the Next Economy MBA to help address this and similar questions. Lift Economy's Next Economy MBA is an online course that's designed for entrepreneurs, aspiring entrepreneurs, students, recent graduates, employees, and folks who want to learn more about transformational next economy strategies and businesses. Join the growing alumni network of nearly 250 alumni who've gone through this program and learned essential skills and hopefully built lifelong relationships for catalyzing businesses in the emergent and regenerative economy. So we encourage you to check out our course. You can go to lifteconomy.com/MBA. The next course, Cohort 7, starts on September 21st, 2021. So once again, go to www.lifteconomy.com/MBA. And now, on with the show. Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy. Alison, welcome to the show.
So glad to be here. Thank you.
So, Alison, what is the story behind Project Equity? How did you decide to co-found it?
Yeah, so my co-founder and I, Hillary Abell, came together. We keep saying 5 years ago, but as the years pass, it's been probably 6 or 7 years ago, came together because we both had a real shared interest in how do we address the fact that the economy really is not working for most people today. And increasingly, you know the stats. It's whether you want to look at the wealth gap or the wage gap or the rise in service sector, low-paid jobs in the economy, kind of whatever macro stats you want to look at. We know that in terms of real people and real lives, it takes more than one full-time job to if you're a low-wage worker to be able to make ends meet. And so I came at it from the perspective of having 20 plus years ago really worked at the neighborhood level, running job training programs with young people of color primarily, and recognizing that the jobs that were awaiting those young people 20 years ago were not very good. The opportunity wasn't really there, and that's only gotten worse for over 20 years. And my co-founder, Hillary Abell, has a deep background in worker-owned businesses. She was a worker owner herself at Equal Exchange in the 90s, and she led an Oakland-based nonprofit that was formerly called Wages, has since rebranded to Prospera. That while she was there, they grew a network of green cleaning cooperatives owned by Latina women into about 100 worker owners strong, and really saw the power of this model, the power of this approach to support people in having better livelihoods, where they had some control over their own things like schedule, the type of work that they were doing, and were able to also begin to put some savings aside in the form of an internal capital account within the business that they could borrow money against for family expenses or emergencies or whatnot. So this is a very powerful model, and yet it's so highly underrepresented in our economy. It's not even a measurable part of our economy nationwide. There are only about 300 to 400 worker co-ops. In other parts of the country, in other parts of the world, that is very, very different. In other parts of the world, this is a normal part of the business ecosystem. And in the U.S., it's just unfamiliar and highly underrepresented. So we came together to try and say, we know the power of this in terms of real people and real people's lives. What would it take to scale this model and to make sure that we have a lot more of this model in our economy.
And why do you think it is? Why 300 to 400 in the U.S.?
It's funny because when I talk to my business school friends about what I'm doing, and I explain how a worker-owned cooperative is structured, and it's not uncommon for somebody to say to me, "Oh gosh, that just sounds so complex." And I sort of stop and pause and sort of look them right in the eyes. And I say, if you knew nothing about the structure of a U.S. corporation, it was totally unfamiliar to you, and I described how it worked, you would probably say the same exact thing. Oh gosh, that corporate structure just sounds so complex. So I think that it's just a lack of familiarity. We don't learn anything about employee ownership. We don't learn anything about cooperatives in any of their structures, whether you're talking about a worker-owned co-op or a farmer co-op. REI is a co-op, a consumer co-op. We don't learn anything about that in our experience through the public school system. And most, if folks go on to college, in terms of your college experience, it's just foreign. It's unfamiliar. So I think it's a lack of familiarity. And so because it's a lack of familiarity, it seems hard, or it seems weird, or it seems whatever it may be. So that's a big part of what we do, is we try to just raise awareness broadly of the model, and we try to raise awareness in the mainstream places that wouldn't normally be talking about worker ownership.
Maybe one of the questions that sort of folks have, and maybe it's a big misperception because I know it doesn't function that way in our company, but maybe it's that worker-owned cooperatives are sort of slow to make decisions, or it's like sort of idealistic. Do you find that that's some of the resistance you get from people who are interested in doing this, or even have heard about cooperatives?
Yeah, and I think you're right. There are preconceived notions about what worker-owned co-ops are and are not. And I would say that, one of the things that we always lead with is study after study after study. If you want to see the data, demonstrate that employee-owned companies are better for the workers, higher than average industry pay and benefits, voice in key decisions, asset building through that business ownership. They're better for businesses, so they build stronger businesses that are more efficient, that outlast their competitors in business cycle downturns, and then they're better for society. So, when you have a lot of these, you see some really positive impacts. And even just there was one study that looked at voting levels and had a correlation between employee owners and employees who had employee ownership and civic participation. So we know that they're better for society, and so the question is, so knowing that, why aren't we building more of them? Why aren't we doing more of this?
Absolutely. And so for Project Equity's standpoint, of all the sort of issues you could have taken up when forming this, why worker cooperatives as sort of a driver to address the economic challenges we face?
Yeah, and I think there are a number of solutions that need to be put in place to really address as Lyft is really focused on, is trying to move towards the economy that broadly serves people and planet. And employee ownership is a piece of that puzzle. And for us, the reason that we've taken this on as our mission is because of those deep benefits. But it structurally builds in. It's a business form that has the business decisions being made through the lens of what's good for the workers, for their families, and their communities. And that's built in structurally. So it's not something that needs to be regulated. We need regulation to make sure businesses aren't making decisions that are bad for people and bad for the communities. And so it's built in from the inside out. And that we need more of that. It's sort of in the way we think of our checks and balances system in our government. We need to have that built in structurally for it to be effective over the long term.
And for folks who don't know, I mean, admittedly, I didn't actually know this question until probably a year ago, but what is the difference between a worker-owned cooperative and some of the other structures, for example, an ESOP or employee stock ownership plan?
Yeah, and we're big fans of all types of employee ownership. So the form of employee ownership most folks are familiar with is stock options or stock grants. And so, especially in the Bay Area with so many tech companies, this is typically a very small percent of the company that is shared with employees in an incentive structure. So you get stock options and they vest over a period of a number of years, and then if the company gets sold, then you realize some of that benefit. And then another sort of more common than worker co-op form of employee ownership is what's called the ESOP, ESOP, which stands for Employee Stock Ownership Plan. And so an ESOP is, essentially, I'm going to just summarize, but it's essentially a retirement benefit for employees. And an ESOP can be 100% of the company that is owned by the ESOP, that is in this ESOP structure, or it can be a very, very small percentage of the company that is in the ESOP structure. And so that's one of the differences. Is a worker-owned co-op is 100% of the company is owned by the employees. So 100% versus a variation in an ESOP. And then one of the other main differences is that an ESOP is a retirement benefit. And there are many wonderful ESOPs that also have profit sharing built in so that you're seeing some financial benefit of that employee ownership today as profit sharing, but it's not structurally in the ESOP model, whereas as profit sharing, it's structurally in the co-op model. It's not profit sharing, it's profit distribution. And in a co-op, it has a different name. It's called patronage. So it's a patronage dividend that is earned by the employees based upon the effort that they put into the business, the hours that they work to make that profit.
Got it. And so if we took it a little bit to the wonky level of legal, because, in the B Corp movement that I'm also involved with, there's the benefit corporation legal structure. And I know that in California, at least, you and I think Janelle Orsi from Sustainable Economies Law Center and the whole Silk team helped pass a co-op legal structure for California. Could you just talk about maybe how, a little bit about the co-op legal structure and how it might differ from, say, like a standard corporation who also is a worker-owned co-op?
Yeah, and just on the passing of that co-op bill, credit where credit's due. That was definitely Silk's leadership, and Project Equity watched and cheered from the sidelines.
Okay, fair enough.
There is in California, there's a cooperative corporation, which is a corporate form that is for cooperatives. And so if you're a worker co-op, you can become a cooperative corporation. You can also structure yourself as an LLC, and there are some other ways to do it, but those are the two main legal structures. And you were asking what are some of the key differences between the cooperative corporation and other forms. And so structurally, one of them is the one worker, one vote. So the way it works in a co-op is to become a worker owner. Another name for that is to become a member of the co-op. There's typically a financial buy-in, which is an equity buy-in to the business. And that financial buy-in is the same for all worker owners, but it can be different across different companies. And it's set to a level that is designed to be a stretch for the employee base, but not unachievable. So in a business that has a primarily low-wage workforce, you might see a buy-in of $1,000 or maybe $500. But in a worker co-op that has a higher paid workforce, maybe it's several thousand or $10,000 or even $20,000 is your financial buy-in. And so you have the financial buy-in, and then you receive one share of voting stock. So every worker owner has one share of voting stock, and with that voting stock, they have the right now to elect a board of directors. The board of directors must be majority worker owners. and there can be. And Project Equity, we typically encourage businesses to have outside board members to bring strategic insights into the business that they otherwise might not have the same direct access to. So majority worker owners are on the board of directors. And in the California co-op law, you have the possibility of also having investor members. So these are members who don't have that one voting share. They don't get to vote for the board of directors, but they are able to, it's a way to bring in financing to your co-op. And in California, you can have investor shares that cost up to $1,000. So you can bring in, investors from your community of up to $1,000 per individual to support the financial growth of your co-op. So that's a really important piece of the new California legislation, is that made that easier to be able to get community investment into your co-op through this new investor, through some refined definitions and ways that the investor shares are structured.
That's really interesting. Yeah, the investor share piece was something I did not know about. That's really helpful, especially with something like crowdfunding or direct public offerings. It really, I imagine it allows co-ops to raise capital a lot easier.
It does, exactly. So we actually just yesterday did a webinar with Cutting Edge Capital where they outlined some of the differences between a direct public offering and in states that have this investor share like California, the sort of differences and the pros and cons and when you might want to use one or the other. Yeah, it is a great way for co-ops to be able to raise capital from their communities.
So talk to us about this co-op incubator. That sounds very exciting. And what is it, and what are you trying to do with it?
Yeah. So at Project Equity, we're really driven by this mission of how do we pave the way or make it easier for folks who are in the low wage workforce to become business owners, and to do that through becoming a worker owner. And so we focus on helping existing successful, profitable businesses transition to become worker-owned businesses. And so a couple of scenarios. One could be that you've got a business owner who's really mission-driven and really wants to become a part of an employee-owned company herself or himself. So sort of a leader who wants to open the tent and invite everyone in. Another scenario is that you may have a business owner who is either retiring or wanting to leave the company. Maybe you've got a serial entrepreneur who, after 4 or 5 years of starting up and running a company, is getting the itch to go start something else. Or you've got somebody who is at retirement age and wants to figure out how to leave their legacy of this business that maybe they've been have dedicated their whole life to or have been leading for several decades. And so we have, with the baby boomers, we have this really once in not just a generation, but once in a multiple generation opportunity or risk, depending on which side of the coin you look at. But we have the silver tsunami of retiring baby boomers, and turns out that they own a lot of the businesses in the United States. So depending on, which numbers you look at, there have been estimates from between 4 million and 7 million companies nationwide that are owned by baby boomers. If you want to take those numbers down to the San Francisco Bay Area level, just to make it feel a little bit more real, that would be between 100,000 and 175,000 businesses in the Bay Area that are estimated to be owned by baby boomers. So over the next, 5 to 20 years, something's going to happen to those companies. And the question in front of us really is, with a significant portion of our local, privately held, locally owned businesses that are going to transition in some way, we can either sit back and do nothing and let them transition towards greater wealth concentration. So let them be bought up by competitors or by out-of-area buyers, and as a result, decrease the vibrancy of our local businesses and local business community. Or we can intervene and we can say this is an opportunity for us, in fact, to help those those some of those businesses transition to be more locally rooted, more deeply rooted in their communities by becoming employee owned. And so that's what Project Equity is all about, is tapping this opportunity as a way to really scale this business model. And so your question was about our incubator. And so how does that fit into this? And so we offer a set of really just a structured set of services to businesses to help them transition from a traditional business structure to an employee-owned structure. And as I said, that could be at a point of retirement, or it could be just because they want to become a worker-owned company. And so the structured process starts with, what does this look like? What is this thing called? What is this thing of broad-based employee ownership? What is a worker-owned co-op? Is it of interest to look at? So they're exploring it. To, okay, well, this is interesting. I want to put some resources into really assessing this. So let's do a financial feasibility of this transition. What would it look like? Could we get financing? Let's assess whether we've got some employees who are interested in becoming worker owners. Do we kind of have enough to move forward? And then if the answers to those questions are yes, then great. We're ready to roll up our sleeves and do the work that it's going to take to do the structure transition to become a worker-owned company, to line up the financing, to structure the deal, because ultimately what this is a sale of the business from the existing owner to the new worker co-op. And that sale is typically financed just like a sale of a house would be, or a sale of a car would be, typically financed by an outside lender or a set of outside lenders. So lining up the financing and getting all of that up and running, and structuring the co-op and the governance, and making sure that the employee base can step into those new worker owner roles effectively, that they understand enough about the business to be able to make good business decisions, and that they have the support they need to really grow the ownership culture.
What do the sort of lenders or banks? Is there any perceived benefit to, say, financing a worker-owned cooperative sort of transition versus like a buyout of some private equity or some high net worth individual? Do you find that in the sort of the financial side of this?
Yeah, well, on the financing side, the good news is that there are a handful of CDFIs, two of which are national and one of which is regional, that have a deep history of lending to worker co-ops and have experience lending in, we call this a co-op conversion. So this transition of existing business to a worker-owned co-op. And those CDFIs with this deep experience also have really strong financial track records. So very low losses, and real success in terms of supporting these co-ops. And so the CDFIs can often come in as a lender. The selling owner will often stay in for a portion of that loan. So they'll take a note as part of the sale, which is not uncommon in any business sale. And then that can often, if you have more, those lenders would come in as subordinated or more junior debt, which would enable a bank or a CDFI that maybe doesn't have experience lending to a worker co-op to be able to come in as more of a senior lender.
When you're talking to a CEO or owner, I imagine there's probably a few common. There's probably like the top three questions they have. It seems like, if just sort of hypothetical, if I were building a business and I had done it for 25 years, maybe there's an assumption that like, I can't sell it to my employees. They can't do it without me, or like I should just sell it to another owner, or maybe it's I think I could make more money selling it to a different investor, or that's a great idea. I should sell it to my employees, but it's too hard. Like I can't do that. What are those sort of like? What are the sort of common concerns or questions that you find with business owners?
Yeah, so when we were first assessing, really, is this a strategy we want to take on? We did focus groups and had lots of one-on-one conversations with CEOs to try and get our heads into this question. And I'll just tell a quick story about a focus group we did with a number of business owners. These were all founders, so these were talking about their business, their baby, that blood, sweat, and tears. And we started the first half of the focus group. We just dove into employee ownership. What do you know about it? What do you think about it? What do you feel? And, if you can picture a group of CEOs around a table who were all kind of squirmy and uncomfortable. So this question of, oh, my employees couldn't own my business. My employees couldn't do what I do. There's this feeling of, oh, it's mine and they're my employees. And it's just an uncomfortable situation. And then we took a break, and then we came back and we framed up a set of questions around, imagine that you're at retirement age and you're getting ready to prepare for retiring and leaving the helm of this business that you founded and you worked so hard to grow and make successful. What do you want from that? And you can imagine the kinds of things that came out of that conversation. This is really one of my life legacies, and I want it to continue on and be successful. I want all of the people who have been on this journey with me, who have helped me make it successful, to be taken care of. So those could be my vendors, my customers, my employees. I care about these people, and they've been there for me, and I want them to be taken care of. If I have a mission orientation, I started this because I'm trying to change the world in some way. I want that mission. I want the business to remain true to that mission. And I want this business to remain in my community. And so that's how we start the conversation with business owners is, what do you want? And then we start to talk about, okay, well, what are some of the options in terms of who you could sell your business to, and how do they line up against these things that you've articulated? And of course, what do I want? I want economically to be taken care of, right? I want to get a good price for my business. So that's the starting point. And some of the preconceived questions or concerns around, oh, my employees couldn't do it. Those definitely come up. And what we say, what we tell folks is, because transitioning to an employee-owned business doesn't mean that you are getting rid of managerial leadership within the company. So there's still in businesses of a reasonable size that management structure is critically important to keeping that business functioning effectively. And if the business functions effectively, then it does all of the good things that the business does, including providing good livelihoods for the folks who are working so hard there. So the managerial structure is really important. And so if you as the GM or the CEO are vacating that seat, it's a question of who's going to come into that seat versus a question of, oh, my employees could never run the company. Right, so running the company, you've got the board of directors made up of majority worker owners, and then you've got the GM and CEO, and the partnership between those two governance and leadership roles is critically important in the company.
Yeah, I think I even had similar naivete around, well, if you transition to a worker-owned cooperative, it just means that everyone's equal and like everyone has a vote, so it might be a little chaotic. But that's not what you're saying, right?
That's exactly right. And in fact, if you go and talk to, we did a great tour of Alvarado Street Bakery. I don't know if you're familiar with them, but just for the listeners, this is a bakery in Petaluma, California. When we toured about a year and a half ago, I think there were about 120 worker owners. They might be bigger now. And they provide bread, sprouted wheat bread to Trader Joe's, Albertsons, Walmart, all of the major grocery chains. And they're about 40 years old. And they tell this great story about, when we were just getting started, we got to a certain stage. We were maybe 15 or 20 people. I can't remember the exact number. And, we just found that we weren't operating effectively. Like we couldn't sort of get past that. And we made a a major decision which helped us become the company we are today to provide these incredible jobs to 120 people. And that was to put in a management structure. So they put in a traditional management structure, their GM role. They call them a general coordinator instead of a general manager, but it's the GM role, and traditional management structure and highly participatory management. Some structures that are explicitly around through conflict resolution or grievance resolution to enable that participatory goal to be real, and for there not to be sort of stoppers to that. For them, they would probably still be a 15-person company, or they might not still be around, decades later if they hadn't made that critical decision.
Yeah, I think that's a critical part of the knowledge, is that it doesn't mean there's just a flat hierarchy now.
Absolutely.
Yeah. So let's pretend I'm a listener and I'm excited and I want to do it. Maybe I have a restaurant, I have 100 employees, I'm in the Bay Area or wherever. And so what should I start thinking about? Like, what are the steps? Can maybe you kind of walk us through like the steps that I would need to start thinking about to make this transition?
Yeah. So the first step would be, learn everything you can about how this works. Look at case studies of transitions to employee ownership. We have a set of a dozen case studies available on the Project Equity website, and learn as much as you can. And if it's still feeling like it's something that you're excited about, the sort of first concrete step is this financial feasibility. Could it work financially? And we recommend that you don't do a lot of sort of dreaming or imagining, especially with your full employee base, if you don't know if it's going to be able to work financially. So you don't want to get people really excited about something that might not be able to go anywhere. So could it work financially? And essentially, the way that we think about this is it's a math exercise. So I'm just going to use a round number here. Let's suppose that your business is worth $1 million, and worth $1 million doesn't mean what you want for it. It doesn't mean what you think it's worth as an owner. It means that you've had a business valuation done on your business, and it's worth $1 million in the marketplace. So let's say it's worth $1 million, and then the question is, okay, well, how is that $1 million going to get paid for? So you've got some equity buy-in from your worker owners, which, in your example of a restaurant, would probably be a pretty low number. So it wouldn't make a big dent in that $1 million. But then you've got the question of, all right, so if I as an owner am staying in for a portion of that loan, and then I'm needing to get an outside loan for 60%, 70% of the value of that sale, if I were to pay that loan off in, say, 7 years at a current business loan percentage rate, what would be the monthly payments, and how does that compare to the current free cash flow, current essentially profits, but free cash flow is a slightly different calculation, so the current free cash flow of my business on a monthly basis. So can I, over the period of 7 years, pay that loan off? And what does that look like? So that's essentially the math that you have to do to see, is it financially feasible? And you need to take into account the loan to the owner in that calculation as well. And so, that's something that we regularly help companies with and are happy to provide support on for businesses. But conceptually, that's how to approach it.
And is there a type or industry that suits itself particularly well for cooperative owner? Like, I notice there are a lot of grocery stores that are co-ops. Is there a reason for that, or is that random?
Yeah, and the grocery stores that are co-ops are probably more likely to be consumer co-ops. There's only a handful of worker-owned grocery stores nationwide. We do have a fabulous one in San Francisco, which is Rainbow Grocery. There are about 300 worker owners, but they're a little bit of a unique beast. So your question was about industries, and there's worker co-ops in every industry you can imagine, even in the United States of our limited sample size of 300 to 400. But if you look internationally, you've got worker-owned companies literally in any kind of business that you could think of. So the fit in terms of it being worker owned, I think is very broad. And then the fit in terms of it being a good candidate to transition from an existing successful business to a worker-owned business is really more around the financials of that business. So is it in a strong financial position? So you've got free cash flow that could help pay off that loan. Is the balance sheet strong so that lenders are going to be interested in coming in to help finance the deal? And is it how participatory is the culture? That's not a required, but we often look at that, because if you've got a culture that is very participatory, it makes the transition easier. And if you've got a company that has a culture on the opposite end of that spectrum, you just have more work cut out for you. So the transition timeline might need to be extended out. So it impacts how things would flow. But yeah, the financial feasibility and the financial health of the company really are the two key ingredients to assess fit.
Absolutely. And let's say the financials look good. Is that when you start having conversations with staff, or what do you recommend folks if the financials look good?
Yeah, so if the financial feasibility is 2 thumbs up, green light, then the next step is to say, okay, well, are there enough employees that are interested in this for us to want to invest time, energy, resources to move forward? And so it's not a total chicken and egg, but there is some work that has to be done to be able to go to the employees and say, are you interested in this? Because what's the this, right? So are you interested in becoming an employee owner of this company? Well, maybe, but what does that mean, right? So what's going to be my financial commitment? What's going to be the financial benefit to me? What's my financial liability? Those are usually the first questions that we get from employees. And then the second set of questions are, and how is this going to change my responsibility, my say, my voice in key decisions? So that's the second level of questions. So you don't need to flesh it out 100% to every last detail, but to be able to go to employees and say, are you interested in this, and have an answer that is reliable in terms of moving forward, you need to have a rough sketch of those things. This is roughly what we think this could look like. And here's the answer to how liability works in a co-op, financial liability. Here's what's on the line. Here's what's not on the line. So to be able to have those really upfront and honest conversations, and then you can do a sort of a straw poll of folks. Okay, what level of interest do you have, and do we have enough to be able to move it forward?
What's the long-term plan for Project Equity? Like, let's say 25, 50, or 100-year plan. What do you hope to see?
Well, we hope that we will have worked ourselves out of a job. So, we will have worked ourselves out of a job when there doesn't need to be a lot of awareness raising about this as a model, when it becomes something that is more normal and more understood. Because right now it's a specialty, it's a niche. If you go in to get help from your local small business development center, some of them, but not all of them, can help you with what a worker co-op is. If you are, if you're trying to get assistance from an exit planner on, your succession options as a retiring business owner, worker co-ops are not on the menu. So that's the big picture, is how do we get to that stage? So this isn't a niche thing, but instead it's integrated into wherever you go, where you're told, well, you can structure your business as a partnership, an LLC, a C corp, or an S corp, or a B corp, or a worker-owned co-op. So once that's in place, then we can close down shop. But in the meanwhile, we're based in Oakland, California. And, as a nonprofit, we have a mission, which is about demonstrating and replicating strategies that increase worker ownership and it's all about to the benefit of low-wage workforce and low-income communities. And so because of that, our work is inherently place-based. So our programs that are focused on the outreach to businesses, the awareness raising, the outreach to businesses, and then the incubator services are place-based. And we also work on what we call at the ecosystem level. So who are the actors in the local economy who can help to get this moving faster and better and more effectively? So whether those be lenders or city economic development or industry networks. So who are those local ecosystem actors? And then at a national level, are there some things that are better done nationally that we need to address nationally? So we are working in the Bay Area, and we have partnerships with groups in other parts of the country. And if we were to roll forward 5 years, I would expect that we would probably be doing work similar to what we're doing in the Bay Area through partners or with partners in other parts of the country in 3 to 5 or more regions across the country.
Wow, and I hope the B Corp community can be a support and amplifier for what you're doing, because I think the missions are very similar.
Yeah, absolutely. And if you look at B Labs does a great, every year they do a best for the world awards and report on the companies that score the highest on their on, I don't remember what they call it, but on they have a point system for all of the ways that businesses do good in the world. And not surprisingly, every year you've got a stable of worker-owned businesses that end up on that list of the businesses that are best for the world, because integrating worker ownership, integrating employee ownership into your business structure is just one more way to really deepen the benefits that the business is bringing to the work.
Do you have any requests for the listeners for help or assistance, or any events you have, or any ways that folks can support what you're doing?
Yeah, that's a great question. And I would say, if there are any opportunities to be able to, we often use the word demystify, what worker ownership, employee ownership is all about, to make it so that it's not as unknown and so therefore feels confusing. Whether those are events or whether it's about sharing any of the materials that exist out there. There are many great organizations working on this. Project Equity is not alone. So please, my request to the folks listening would be, do whatever you can to help raise the awareness of this, because it is, as I mentioned, a very highly underrepresented but very impactful business model.
And one shout out for a resource. I'll say one, and then I'd love to hear more about the resources and events and white papers that you guys have written up. But a shout out to Owning Our Future, the book by Marjorie Kelly. It's a fantastic book on worker ownership. And I also know I've looked at the Project Equity website, so maybe could you share the website address and then maybe some of the resources people can find on your site?
Absolutely, yeah. So our website address is project-equity.org. And we do have a number of white papers. So a good starting place for folks who are new to worker co-ops is a publication called Worker Co-ops Pathways to Scale, which really lays out what's the current state of the worker co-ops in the United States, and what are some of the barriers to scale and some ways that we can overcome those barriers. For folks who are more interested in worker co-op conversions and how they work, we have a set of 12 case studies on our site, as well as an FAQ and case studies of financing. So how does the lending side of this work? How does the loan for the co-op conversion work? And then we regularly do webinars and have the recorded webinars up on our site as well, for folks who are interested in learning more.
Phenomenal. Well, It's been amazing talking to you, Allison. I'm just really excited about worker ownership. And to me, it's just one of those ideas where when you say there's 300 to 400 in the US, it's like, well, this is definitely going to grow because it's such a great
Mm-hmm.
idea. So um, it is a smaller community, but I'm very optimistic. And so just wanted to thank you again for demystifying and sharing your message. Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.